Hello and welcome to our Sahi SIP Season 2. When we started the Season 1, the attempt was to really get the right messaging across on how you can time not the markets but your goals. We want to start and take that pitch forward with a promise that if you time your goals and if you're committed to remain in the market during volatile times, sooner than later your goals would be met. At ET Now this year, during the Diwali time, our theme has been Naya Saal, Nayi Shuruaat. So for an investor who has felt the heat of market volatility, how should you stay invested and stay committed? So to discuss this theme of Sahi SIP Season 2, I have with me the CEO of Sundaram. Sunil, thank you very much for joining us.
Thank you, Nikunj.
Everybody in the markets, they want the meat, but nobody wants to feel the heat, right? Last 1 year has been all about the heat.
Yes. So I think the consequence of heat is that a burnt child rests the fire.
Yeah.
Right? So that would probably be the way to express what investors are feeling. But I think the key is the heat can also be used to warm it and slow cook your meat to the right tenderness for you to enjoy a hearty meal. So I think the heat is a good lesson in the journey, that when you look at always the goal is the end of the road. The fact that road has potholes and speed breakers may slow down the pace, but ultimately if the end goal is in sight, right, I think sticking to the journey, and that's where, unlike a normal journey of a truck or a car going and losing steam because of the speed breakers and hence probably reaching its goal later, the stock market has this wonderful vehicle called SIP, which actually makes you benefit from everything because you end up buying more when there is difficulty. So I think the classic case that actually, if you look at it, there are two things which I want to point out to people. One is a smooth road and a bumpy road. If at every bump somebody gave you 1 rupee, you would rather prefer a bumpy road. So treat a SIP like that, because a smooth highway will give you a smooth journey, but the end result will not be as great because you have lost out on that 1 rupee you would have got on every kick one. The second thing which I wanted to say was that SIPs today, and we were discussing just before the show, right? There are 2-year SIPs which are negative, maybe some 5-year SIPs are also negative. So people are saying, oh, you sold us this great mantra of SIPs being that El Dorado, right? Solution. Why is it negative? So I think one basic rule when we talk about the power of compounding and its growth is that a SIP, like buying rupee cost averaging, buying little every month, buying more when it corrects, pays off when the end point is higher than the start point. Now I mentioned a road full of bumpiness. Now you set your goal to say, I will reach from Bombay to Delhi. Kota comes in the middle and there's a bump there. Now if you leave the train at Kota, your experience is of a bump. So my point here is that whatever you've chosen as a goal, right? Yes, there is the off chance that the goal determined by you might be a time when there is a bump.
So yeah, that's the point. How do
that is
you
the point,
deal with it?
right? So the key point is that when you set a goal, there has got to be a time goal and a value goal. And what I would generally recommend is that when you reach the value goal, even if it is ahead of your time goal, you should then move it into a less volatile asset, because that means the value that you want. So because most people in a long term can't put a pinpoint to an exact time. So you say your daughter's marriage. You will give yourself a 2 to 3 year bandwidth in which your daughter would get married, your son's education. So you will have generally a good bandwidth. And even if there's a specific date, let's say now you know your son is going to go into college, want to send him abroad in the year 2030, let us say. But the point is, in your planning, it shouldn't be 2030, it should be 2028 to 2032. Yeah. So when you give yourself a band and then set yourself, right, a financial goal, the achievement of that financial goal should enable you to take out that money, because it is fraught with risk if you stick yourself only to that date goal, because neither you nor I know whether Mr. Trump is going to be power in 2030 or a Trump-like person, what the world scenario is. So given the fact that in a SIP, the end point has to be higher than the beginning point, I would say marrying a financial goal to a time band and then cutting your exposure and parking it in a safer, less capital market risk-oriented asset. there are multiple that we can discuss, is probably the best way to ensure that you have a happy investing experience.
Okay. The challenge with a SIP investor is that markets are volatile. The challenge with the debt market investor now is that they've realized that debt is also not safe. When you see headlines which are talking about slowdown in autos, problems in NBFCs, India's growth coming down, it shakes you. It shakes your basic thesis that have I gone wrong? A, I have gone wrong. B, the news has not moved as per what I thought. And C, I've lost money. And C is the most important thing. When you lose money, you think again.
I think that's a very fair state of emotions. And so broadly, if you want to put it a very sharp thing, there are two emotions which drive investing. There's fear and there's greed. Now you can say, if you're fearful, you'll put your money in safety-oriented assets. If you're greedy, you'll put in risk-oriented assets. The issue that most investors have to grapple with is that only when the greed comes, only when the past returns show themselves. Right? But if anybody analyzes the breakup of the returns, for example, the Sensex, right, has gone from its inception over a 37-year period to 38,000. If you can believe that 80% of the returns were made on 40 days out of 7,400 or 500 days, because it is those days when everybody was fearful, right, that the maximum money was made. So I think what I would like to say here is that one is the emotional of fear versus greed, but there is also the right brain versus the left brain. The left brain drives the emotion, right brain drives the logic. So the logical thinking, the human being, what separates us from animals, and animals react purely on emotion, right? When it's hungry, it goes and attacks. When it's fearful, it runs away from the lion. The logic element of it tells you that the smartness lies in buying when others are fearful. So I think that what people should do is not lead into investing purely from an emotional grab, but to overlay it with the logic. And the second thing you mentioned, right, the near-term news, right, is the one which scares us. But the winner is always the person who looks beyond the pothole in the short term to the pot of gold at the end of the road.
So a graphic will just come up on your screen, and what we've done is that we've put the Nifty graph from 2000. We've left it unchanged. I would request our viewers to guess where 9/11 was and where 2008 was. Now those data points will come up on your screen. So with naked eye, on a 20-year period, you cannot guess where 9/11 happened and what happened to market that time and where 2008 financial crisis was. So you are saying that if we take the graph forward, which is 2025, we will not be able to identify the blip of 2019.
Absolutely. It will be like, from here the moon looks a very smooth thing. When you get close to the moon only, you see the craters. Right? Otherwise, you see a round goal moon.
Chandamama we call it.
Chandamama we call it. Right? So I think that's a very, very valuable point that you're using the Nifty chart to show. And I wanted to say, like today, you're saying there is fear. And people are saying my recent return. But can you believe? And so hence, since you're saying a 2-year SIP, all I'm trying to say is if you take the 15-year returns, and most goals are got to be 10-year, 15-year plus. Even today, at a time when you feel the markets are not at their best of conditions, a 15-year Sensex has delivered, Sensex and Nifty have delivered 14% return, and the mid-cap index has delivered 17.8% return. And today, mind you, you are at a reasonably uncertain, volatile phase of the market. If this had been booming, those would be 2 percentage points higher on a compounded annual basis. So my point is, if you are long enough up there, even if I mentioned in the beginning that there could be a blip when you do, so time your exit if your financial goals are reached. The point is, even if you don't do that, if you stayed long enough, right, the fact is that your wealth would have grown multiple times. And what is the reason for that? Because ultimately, the big dragon that all of us are fighting is a dragon called inflation. The softness of crude prices over the last few years has kind of softened us to inflation as a risk. But bear in mind that over a long term, 7% has been the average annualized inflation, and your fixed deposit, whether it's through a bank or a private sector, even if it gives you 1% alpha, post-taxation, you're actually going to destroy real wealth by putting in a fixed deposit kind of an asset. I'm not saying fixed income because then the mutual funds come in. So my point is that the only asset class guaranteed over the long term to beat inflation is equities.
Okay. Right. So just to put it simple, you are saying that the path of India is headed higher.
Yes.
So you should buy even in good times and even in bad times. And that is what you should consider. The trajectory, the direction, the momentum, whether it's this year or next year, whether it's 2022 or 23, we will be a $5 trillion economy. So if we will be a $5 trillion economy, the best way to participate in India's growth that you buy in good time and buy in bad times. This is a bad time, you will buy more. In a good time, you will buy less. But if you're buying in good and bad both, you'll average out beautifully.
Correct.
I'm putting it very simply.
I think you're putting it very, very simply and very correctly. And the reason for India's future, bhavishya, to be good is a very simple fact, and which in the market jargon we call it demographic dividend.
Can you explain that?
So what I'm trying to say is, thanks to the productivity of our elder brothers and sisters today, India is in a unique spot. And I'll give you just one data point to show you that, is that between 2017 and 2027, if you take 18 to 55 as a working age class, right? China, which is the main competitor, which has become the manufacturing capital of the world, is going to lose 21 million people from their workforce. In that same period, India is adding 117 million people to its workforce. We
have a young population who will start adding to the economy. As a result, economy will do very well.
Not only they add to the economy, when they get jobs, they'll start buying. So they're not only contributing from a supply side of helping India manufacture for the world, but they're also going to buy and make India the marketplace of the world. And this is an inexorable reality, because nothing's going to wish away those people.
Two very interesting graphics here. Number one is that entry is important to decide future returns, which is that if you've started at P multiples in the mid-cap space, when P multiples were below 20, what have been the next 3 to 5 year returns? Very important. Entry decides the near-term return. We're talking long-term, but I want to be priced to long-term. Second, think about a simple thing, a cup of coffee. How much it was costing you 10 years ago, 5 years ago, and 5 years from now. Equity is nothing else but buying future purchasing power. We are talking long term here, but I want to bring everyone's attention back to the fact that entry points do decide the 3 to 5 year return. If you bought at the peak of the bull market, next 2-3 years you may not make great returns. If you buy at the peak of bear market, your return potential increases higher. Correct. Given where we are in terms of valuations, and I'm talking about the benchmark which you use, which is BSE 500 for the mid and small cap indices. Is this a good entry point where the margin of safety lies with the long-term investor?
I think you put it very correctly there, because what today is you're seeing is that you're seeing somewhere between 18 to 20% discount in valuations of the broader market to the top end of the market, right? Now, if you say discount, when actually speaking, the broader market should deliver 18 to 20% better EPS growth than the larger market. So you're actually talking about a 30 to 40% discount if you were to say that broader India. And why do I say this? Is that the larger part of the market tends to be a victim of fund flows. Yeah. But the broader market is essentially a correlation to India's GDP growth, because that's what translates into business. So the valuation story may help you to protect yourself or make some decent returns from the larger in the market. But you take a broader BSE 500, the fact that the Indian economic growth translates directly into order books and valuations and earnings growth, and as we say, the market is a slave to earnings. So I think that from a purchasing point power for the next 3 to 5 years, I think you are at probably the best purchase point from a 5 year perspective. Okay. So I would say that doing an allocation, starting an allocation now is a very shubh muhurat in this Naya Saal Nahi decision. I think we are at a ideal takeoff point from an economy perspective and a valuation perspective to buy the broader market.
So Lakshmi ji is, the valuation in terms of Lakshmi ji is on your side?
Yes.
Okay.
Right. So you have to use Saraswati ji to make that decision.
Exactly.
To take advantage of Lakshmi ji.
Great point. Now, a lot of people, asked, we are in our 50s and we want to buy stocks. The first answer sometimes is don't. Because you don't have the time and the risk appetite. Do you think somebody who's in 50s, nearing retirement age, they should not think of buying stocks at all? Whatever may be the risk appetite. But are they too late in starting a SIP?
So one interesting fact which we don't realize, because it may apply to you but you're not aware of it, is that over the last 30 years, India's average life expectancy has today touched 70.
Okay.
And when you say average life expectancy, you're taking the poor man on the street who doesn't have access to medical facilities to the rich man who can go abroad for the best possible treatment. So if you take the normal middle class, I would say the average life expectancy is closer to 75 to 77. So even if you're close to retirement, bear in mind today that the chance and the probability that your post-retirement life is longer than your working life is a real possibility. One. Second, without attributing anything to the younger children, today we are in an age where depending on our younger children to take care of us is, I think, something we have to dilute, because the modern day and age, what's happening in the Western world is an independent society where we took care of our parents, but I think we all agree that we don't want to burden our children with taking care of us. So building that independence, right? So at a retirement stage, if you are going to put your entire corpus into an annuity and eat it off, the likelihood that your money spends out before your life runs out is quite a real possibility. So the ideal thing is that you got to create a balance, because over a 10-15 year period, which is very likely because you're going to live for 25 years, you have to bucket your rest of your life just as you did when you're starting your working life, and have the equity markets to deliver that return, because the inflation 10 years from now, 15 years from now is not going to, because in an annuity the payout is monthly. So you have to hedge against inflation even when you are 50 plus, because you really have a very, very long term in today's world, 25-30 years of life left in you, where you want to, and you're going to be a healthier person who will want to spend money and spend a good quality of life. So I think equities, the old rule used to be 100 minus your age, and I think today that has become already 120 minus your age.
Okay.
In terms of it. So that's the fundamental reset due to improving health quality, which has happened. And I think the better we recognize the reality and realize that it's never too late to use equity as a performing asset class to achieve goals, right, is something which you got to internalize, and you're not old enough. The second point which I wanted to make is that because our per capita income has gone up and we are better well off than our parents, one fundamental thought process which has happened in me, and I'm sure in you and others, is that we want to leave a legacy for our grandchildren. So when you do an SIP, assume an unfortunate happens, the fact is you do a nomination, your grandchild's life has a 50-year extension to it. So starting a longer term SIP, even if it doesn't mean that you don't enjoy the benefits, gives you a great value addition that you're leaving something for your grandchildren to enjoy and benefit from equities.
So the best day to start the SIP was yesterday, it is today, and it will be tomorrow.
Yes.
You can start a SIP anytime, irrespective of what income bracket or what age bracket you are in.
Absolutely.
Okay. I've been wanting to ask you this question, and over the years, purely as a television commentator, I've seen that information flow has become seamless. 20 years ago, to talk about Buffett, it appeared almost you're talking about some alien, at least to Indian audience. Sure. Our audience today is well versed with the global gurus, they interact with you. Do you think because of communication and because of internet and because of bandwidth, investors have become smarter? Or have they become aware but the behavior has not changed?
I think investors have become intellectually smarter but not financially smarter.
Why is that? Intellectually, if you know cycles, there is enough history which tells you that every time you start a SIP, you look beyond 10 years. I don't think any SIP has given a negative return on a 10-year period. There is history to back it.
Yes.
We listen to doctors because they understand history, but we never listen to fund managers because they also speak the history.
Yes. I think one of the key reasons for that is the bane of the internet. The propensity to act has become much, much faster as opposed to the propensity to think, reason, and then act. Okay. So I think the ability to invest at the click of a button, the ability to redeem at a click of a button, the ability to be reactive. So I think a lot of our parents gained from the fact that there isn't access.
They were inactive.
So I think that you actually need to go back in time and say, can I put a pause to my trigger happiness?
That's the reason I'm asking this basic question is because that's where it is. Everybody has a view, and that view is also changing, forcing you to change your financial planning.
Yes.
You have a financial goal which is meant for 15 years, but because there have been 15 weeks of bad news, you've changed your 15 years of financial planning in one shot.
Absolutely. So, and I think that this this, and you took the allegory of a doctor, right? And you take the doctor. But today, what happens, with the doctor, right? The first thing you go prescription, you go and Google what it is. And then you take your call, you look at the side effects, and then you try to modify it yourself. So I think it's the same thing in the financial. The issue is that the access to money through the internet, the access to information becomes so cheap that we have lost respect for the money and for the information. And I think that's where I think the youth, we probably need to do the education that thinking is a God-given gift to the humankind which is not there to the rest of the animal world. And if you apply that and then you realize that in a market where multiple participants are present, the herd mentality actually delivers opportunities to you when you are contrary to that. So I think a little bit of reason and thinking before acting would help investors go a long way and not reacting to every trigger in the market to go and do something on your finance. So one suggestion here is when you write down your financial plan, right, you shut it like a Godrej cupboard, fill it, shut it, forget it. The old Hero Honda had should be your financial plan's goals. Once you've put enough
and don't change it because you have a bad headline here, because something is happening in this sector, because something is going wrong in the world.
Yes.
Don't react to every tweet in the world. Don't react to every headline in the world. Stick to your financial planning, because if you are in for the long haul, you will be rewarded.
And I think that's the oft-repeated saying, right? Time in the market has delivered far better value than timing the market. And we've said this ad nauseum in that, and it holds good now also, right? And I think the key here, the time in the market is one concept. You can put a lump sum and say, forget it for 30 years. But I think discipline. I think that's the point. If you're a disciplined investor, right, who are consistent to the plan, you keep executing to plan, right? Then you will be the winner.
So the mantra to create wealth is a start early. That's the E part.
Yes.
Invest, that's the I part.
Yes.
Invest regularly, that's the R part.
Yes.
And D is the discipline part.
Yes.
So these are the 4 pillars. If you stick to them,
correct,
you have your basic financial planning right.
Absolutely.
This is what we should
yes,
communicate and educate and try to send a message across.
Yes.
So my last question to you is that we are making investing sound very simple. If investing is so simple, how come you don't have too many billionaires who are investor billionaires in India and even globally? Why is investing easy but not? Why is investing simple but yet not easy?
I think I would attribute this to emotions.
Okay.
Right.
I'm getting into the behavioral part with you because that's what I've understood in the last 1 year, that irrespective of your initial thought, your emotions take over and then you go, all garbad with your financial planning.
So that's where, and a few minutes ago I alluded to this, right? There's a right brain and a left brain, and for people who don't know this, it's a right brain which drives your left-hand sides. The lefties are all the more emotional, artistic thing, and it's the left brain which links to your right side of the body, which is the more thoughtful, logical, rational, quantitative, those kind of things. So while investing becomes an emotional decision, right? It is the logical investor who understands that buying when others are fearful, consistently being disciplined. So I think it is the humanness, right? When I say humanness, not the human emotionness, the human ability to logic, think and write, so those investors, so it's very simple. Now let's take this into the fitness world. We all know eating less, exercising more will do us well. But how often we see that pizza joint and you say, oh, I worked extra in the gym today, so let me have that pizza. The point is that if you don't yield to that, so that's why I say again came down to discipline, right? So those who succeed in fitness, I would say arguably financial fitness is better.
It's festival time, so I'm going to use the word sugar, that it's good to enjoy sugar occasionally. But in financial market, please don't have the sugar rush. You must avoid sugar, especially when emotions they take over.
Correct.
So enjoy the festival.
Yes.
Have mithai.
Yes.
It's Diwali time. Yes. But for financial investing, please avoid sugar rush.
Absolutely.
So wonderful to have you on the season 2. We started with the whole thesis of where the long-term investing is headed. We spoke about emotional intelligence and what people should do and what they should not do. It's been a very simple conversation. It's been a very chatty conversation. So I look forward to many more interactions going forward.
Thank you, Nikhil, and wishing all your viewers a very Shubh Diwali and a Shubh many more Diwalis based on the decisions you take this Diwali.
Thank you very much.